One of the primary objective of any business organization is to earn profits. These profitability ratios are the overall indicators of the performance, results, profits of any business organization. The first profitability ratio is gross profit ratio. Gross profit ratio consider the gross profit and the relationship between gross profit and revenue from operations. It is expressed in percentage terms and the formula is gross profit divided by revenue from operations. Simply gross profit divided by net sales into 100 if it is indirectly given. This ratio indicates the relationship between the gross profit and net sales. And if this ratio is higher the ratio, that means the cost of goods sold are lower and will indicate higher profitability. Therefore, higher the ratio, better the results. So, higher the better, that is the more the better. Gross profit can be calculated as revenue from operations less cost of revenue from operation. Simply speaking, net sales minus cost of goods sold. Cost of goods sold or cost of revenue from operations. And this cost of revenue from operation can be calculated as opening inventory plus net purchases plus direct expenses minus closing inventory. Mind well, in opening and closing inventory of stores, spare parts, loose tools are to be excluded, not considered. Reason? These are used in the production process. Directly, these are not goods. In fact, some of these spare parts, loose tools are even treated as fixed assets. Some of these. Cost of revenue from operation can also be calculated as per the format of the statement of profit and loss of a company. Cost of material consumed, purchases of stock in trade, changes in inventories of finished goods, come popat come, plus direct expenses, if any given. And if it is not explicitly given, we assume them to be nil. The second ratio is the net profit ratio, similar to the gross profit ratio. In the gross profit ratio, we were studying the relationship between the gross profit and revenue from operation. In this ratio, we will be considering the relationship between the net profits and revenue from operations. The most important announcement regarding this net profit ratio is that CBSE has made an announcement that you need to calculate the net profit ratio in two ways. First, considering the net profits before tax, and second, considering the net profits after tax. You need to calculate it in both the ways, even if the question is silent regarding this. Most of the books have mentioned only one of the formulas, but please keep it in mind. So, net profit ratio. Net profit ratio is expressed in percentage terms, therefore we multiply by 100. Net profit ratio is net profits after tax divided by revenue from operations into 100. नेट प्रॉफिट आफ्टर टैक्स डायरेक्टली दिया हो तो फाइन, नहीं दिया हो तो वी नीड टू कैलकुलेट इट फ्रॉम ग्रॉस प्रॉफिट रेशियो. ग्रॉस प्रॉफिट दिया होगा, वी नीड टू ऐड other income to the gross profit and deduct indirect expenses and tax. Why we are deducting the tax here? Because for a company, tax is considered as an expense and we need to calculate the net profits after tax. Therefore, we need to deduct the tax from the gross profit figure. And the second formula is net profits before tax divided by revenue from operations into 100. इससे डिफरेंट आंसर आएगा. नेट प्रॉफिट बिफोर टैक्स डायरेक्टली दिया हो तो फाइन, नहीं दिया हो तो वी कैन फाइंड इट बाय एडजस्टिंग द ग्रॉस प्रॉफिट. इन द ग्रॉस प्रॉफिट वी नीड टू ऐड अदर इनकम एंड डिडक्ट द इनडायरेक्ट एक्सपेंसेस. लेकिन टैक्स लेस करने की जरूरत नहीं है. द रीजन इज वी आर कैलकुलेटिंग नेट प्रॉफिट before considering the tax, that is before deducting the tax. This net profit ratio indicates overall efficiency of the business. Overall in a sense हमने सारे items को consider किया. Higher the net profit ratio, better the business. The more the better, the higher the better.